So, good morning, students. Today I have decided to discuss a very unique topic that financial statements under the course of the agriculture finance and corporation. These are very important statements. For example, the balance sheet and the budget statement and the profit and loss statement, and sometimes the certain ratios like the net cost ratio and BC ratio. So we'll discuss in this chapter the two important that the financial statement. One of them is the balance sheet, and second one is the budget. So these balance sheet, it's a it's a statement which give us the indication about a business on a particular day, about the assets and the liability. And budget, we know that it's a statement of the future investment. It's a statement of the future investment, and which gives us the clarity about the what will come and what will go in which way go. So that these two statements I'll discuss with you. You just remain, stay connected. I will share with you the screenshot, and we'll start discussion on that. Thank you very much. I still remain connected. So, good morning, student. Today, I have decided to discuss a very vital topic under the course of agriculture finance and corporation. Are two important is similarly as it is in other any occupation. So, what are the final outcome objectives of this study is like that. First we'll discuss and learn about the definition, concept and classification of budget. The actually budget is nothing, it is just the statement of that explanation that what we have planned for a year. Generally we are planning for a year. So this is the thing which we'll discuss in coming this particular discussion, and then the key elements and importance of balance sheet that we'll also discuss. So let us have a first discussion on the budget. Budget is an estimate of income and expenditure for a set period of time. It means this is generally we in what way we allocate our income and resources in next coming year. Particularly, generally we prepared budget for a year. So we'll see that the how we can have what kind of that inward and outward, that explanation you can see through the budget. Actually, what are the possibilities those who are there, uh, according according to the availability of the resources, we will allocate those resources in accordance to the priorities that we have decided in our policy. So budget is nothing, it is just an estimate of income and expenditure for a period of time. Generally, we are preparing this thing for a year. Government and other agency, they even the financial organizations, even the other industries, they prepare the budget. Sometimes they can classify they utilize those resources. It's an explanatory note which is available in the form of the budget. So role and significance and feature of a budget. Let us see that what are the role and so in budget first once again we'll discuss that an estimate of cost, revenue, resources over a specific period, reflecting a reading of future financial conditions and goals. All these because the budget allocation is like that, to looking up the financial health of the situation in future. On the basis of that, we are allocating our resources in coming year. So what are the role, significance and future of budget? Let us have a discussion on that one by one. Plan of action for achieving quantify objectives. Yes, through budget we can achieve our quantify objectives, because objectives, they are nothing, they are just the small steps towards the final destination. but towards the goal, towards the final that we want to achieve through our vision and mission for an organization or for an institution or for a government. So budget is one of the important instrument which can have to help in achieving quantified objectives time and again during the year. Then the second is standard for measuring performance. Yes, what actually when the entire year over, then we'll see that what we have achieved, what we have achieved. So this is actually a standard for measuring that with the allocations in last 5, 10 years or 20 years or 50 years, what government has achieved, how much budget they have allocated in agriculture, industry, or any other sector. So what are the impact of that when they have allocated the resources in a way like that to on the basis of the priorities those they have declared in the policy or in their election that campaign during their election campaign and election that note before they are generally issuing. So on the basis of that they analyze that what actually the lacuna they have and what can be further done for the betterment of the society, betterment of the country, or betterment of the any of the segment which they have taken into the task in the priority. So device to coping with the for easyable adverse situation. Yes, if we see that the pandemic or sometimes the natural disaster or sometimes any other that situation that can be predicted by and that the resources can be allocated accordingly. So nowadays we'll see that in our country the resources of the government they are allocating reallocating in the health and health sector, in the health and other sectors, those who are allied with the to upkeep the to maintain the health of the society. Preparation of cash flow statement. Yes, we on the basis of the budget we can prepare the inward and outward cash flow that on daily basis, and then we can find out that what we have actually allocated in budget and in what way we are going. So this cash flow budget is also the part of the cash flow, that is statement which we are preparing on almost on daily basis. That can be the part of the budget. As assessment of credit requirements. Yes, this is the statement through which we can understood that what kind of the future needs we have, and for fulfilling those needs and demands, what kind of that financial arrangement is required, how much credit we have to borrow from which agency. That can be also we can go through the budget. If we prepare budget, we have that kind of explanation with us, so we can arrange accordingly the financial requirement of the company or the institution or the state. The tool of maximizing the return. Yes, through budget we can allocate our resources on the basis of the priorities. So we can through this we can have opportunity to enhance our returns finally in our kitty. Estimation and judging of economic viability of a farm. Yes, this is the statement actually through which we can judge the financial that status of or viability of any institution, any government, any country, like that. So that's why it is very important. So this is the significance, and these are the significance and the feature of a budget. Now, the type of budget, that two type of budget generally we have. The partial budget, it's part of a farm business enterprises. It's a part of farm business enterprises, and the complete budget. Complete budget, it's the entire business activity we prepare for a year. So these are the two category. Among them, we have we have classified the budget. Partial budget, it's just a part of farm business enterprises. It means for quarterly, in what way? So the final budget, in what way we can apart this budget into quarter wise. So that kind we can call it a partial budget. Source of information available for use in preparing budget are, what are the information actually? Those who are the basic needs, those who are required for the budget preparation. They are like that. And under these information, we are not able to prepare the exact budgetary allocation of our resources. So what are those information? Actual farm record. If we are budgeting for a farm, then actual farm records be required. Either it's a dairy farm or poultry farm or agricultural farm or fishery farm, or any other else, even the industry, agro-based industry, or any other. That what are the records? In what way they are getting their income? In what way they are spending? What are the resources they are having? All the information we required. So records on record if we required. On the basis of that, we can have the allocation of the future plan of action through budget. Area summary analysis. Yes, that the summary, that the note of summary is also required regarding the resources that organization or the firm is having, and in what way they are getting their income, and in what way they what are their priorities. All these things will be required before the planning of the budget. The summary of the sum of these information is also required. Then the country production data. Yes, for analysis and for comparison, we require the similar type of business or similar type of that information which is owned by other business, so we can have the reasonable comparison and we can have better understanding before allocating our resources through budget. Then the country production data, that how, in what way the other produces, that also we require. What is the production cost, what is the maintenance cost, all these information if we are having, then it's better for us to allocate our resources in a judicial manner, that we can have finally the better and our most earning as we are doing in the past. That the typical budgets of a few years, last years, that we also require to analyze that in what way actually the resources are being allocated in the past, and what are the outcome of that allocation. That if we have that understanding and that information with us, it's very easy to us to facilitate the accuracy of the budgetary allocation. Then the form literature. Yes, we also require that what is the literature, on what reason and mission the form is working. So all these kind of information, literary information also required. Information from meetings. Yes, what kind of that meets those are being organized by the firm or is business or the institution or the state. What are the outcome of those meetings? That also being required. So we can allocate our future course of action on the basis of the outcome and the contribution of the meetings. Then the neighbors. Yes, what the neighbors and other competitors are doing. That information if we are having with us, it's very good and it's very reasonable for us to allocate our resources in the form of the budget. Now the first one, as we know that we have classified budget into the two segments, the partial budget and the complete budget. The partial budget is useful in analyzing the effect of change from an existing plan. This budget only consider revenue expense item that will change with as a defined change in the plan. So we can assess that whatever the allocation we have made in the complete budget, if we prepare simultaneously the budget for 3 months or for half 6 months, so we can assess the pace and the direction and the changes those who are there in after allocating the resources in the direction that as per our priorities while we are allocating our resources through budget. So if the pace is not in the direction which we have decided, we can change all these things in our complete budget also. So partial budget is also a very much helpful tool to control the pace and the achievements, and we can analyze them time and again. So we can reallocate our resources, we can reassess the situation, and so finally we can improve our final achievements and returns. Partial budgeting is a procedure where receipt and expenses which increase, decrease with a change in organization on procedure are listed in a systematic order. It is a process to follow. It is a process to allow a total farm budget to be fine-tuned. Yes, because if we have these kind of that steps, 3 months, 6 months, in the third, fourth of the year, and finally we have the final outcome annually. So these are the steps where we can have the check and balance, that what are the status of the changes those we have done in the form of the budgetary allocation, that in what way they are moving. So we can have this kind of that we can do our fine tuning of our budget if at all they are going if they are not going or not moving towards the desirable direction as expected, as allocated in the budget. So we can fine tune our final budget through these partial budgets.
It focuses the analysis of a defined change to see if it is improves the total farm budget or not. What is the direction actually that we can assess and we can judge through the partial budget, and we can make necessary changes if at all it is required in the steps those we have decided in the form of the budgetary allocations. The steps in constructing a partial budget are to state the proposed alternative or change that will be analyzed. State the proposed alternative or change that will be analyzed. This is the steps. Collect data on the aspect of business that will be affected by the change. What are the affection? What are the impact that we have to assess quarterly or monthly or like that. That can be we can have the assessment, and we with the information that what are the changes those who are being carried out after the budgetary allocation. Classify or group the type of impact that will occur by including expenses increase or reduce and receipt increase or reduce. Yes, that can be easily, because budget is nothing. It is just the statement of receipt and expenditure for a period of time. If the period is annual, then we'll call it complete budget. But if the period is of 1 month or week or like that, or 3 months or like that, then we can call it as a partial budget. So because it gives us the timely signal that what we are doing exactly. After that, the allocation of all the resources in through the budgetary allocation. When we have incorporated those changes, in what way we are proceeding, what is the direction, what kind of signals we are getting after monthly analysis or quarterly analysis. So we can, if at all it is, if we are going in a desirable direction, then it's okay. But if at all, because of any reason that we find that because of that we are lacking towards our that final that destination which was supposed to be achieved within a quarter, so we can gear up our all the activities, we can gear up our all the efforts. So this kind of that partial budgeting is very much helpful for doing these things. Now, the whole farm budgeting. This is very important that finally the statement of income and expenditure for a year, to whom we are calling the final budget. The whole farm budget is a classified and detailed summary of the major physical and financial feature of entire farm business. Yes, this is the picture of the entire farm business, that in what way will go in next coming year. Whole farm budget identify the component part of the total budget business and determine the relationship among the different parts, both individually and as a whole. So this statement give us the entire that activity of the stakeholders among the business. So and individually and as an organization, as a department, as a stakeholders, it means all the stakeholders, they are being discussed over here. What was their action plan in coming year? In what way we have allocated our financial that that income, and to enhance their productivity and potentiality, in what sector actually we have decided to put our more efforts, and what are the resources those we have arranged for, and how much the credit is required, financial that thing is required to support the changes those we have made in the budget. So that kind of that whole budget is there, and this is the whole budgeting process to develop a farm. What are the process actually? In what way actually we proceed to achieve the whole farm budget, or whole that budget to whom we are calling the annual budget? List of the goal and objectives of the farm. Yes, this is the primary thing, that what is our objective and goal. Objectives, they are the steps towards the final destination or goal. And what is the vision and mission of the government, or mission of the institute, mission of the business, that are the prime that information which is required before drafting the budgetary allocations for next coming year. Then the inventory, the resource availability for use in production. Yes, what kind of that inventory we are having. We cannot plan if we have the sufficient stock of a particular product or service with us. So the first priority will be then that in what way we can have the immediate liquidation that stock. So in budgetary allocation, we can plan what kind of that new product or services we are going to launch in the coming months, or in the coming upcoming that year. So these all are things, they are very important, that when we go through this information of a business, then only we can have the accuracy in budgeting the resources. Determine physical production data that will be used in input output process. That I have already, that what kind of inventory lying with the company, what kind of inventory lying with the business, what kind of the resource we are having in our kitty, and what are the portion of that inventory is lying in the market also. If X product we have dumped, like anything of marketing people, they have marketing and sales professional people, if they have dumped 2-3 times budget that product into the market, then even then we don't have the inventory in our hand, in our stock. But we know that the incoming last 6 months, 7 months, there will be no demand from the market. So we cannot produce the product in a way like that, because that what we have to assess that on the demand and supply, that situation of a particular product or service, what is the status in the market, what kind of the stock we are having with the stockists and the retailers, or like that. So we can plan our budget with the information, if we are having that information with us. Then determine that we have discussed, and identify reliable input and output prices. Yes, this is very important, that what is the reliable input and output prices. If we don't know about the input and output prices, then then we cannot forecast what will be the income and what will be the expenditure, because we have to have approximately that almost accurate information, almost accurate, I'm saying, not 100%, because sometimes the changes are because of any untoward incidents, they might be there. But whatever the trend we have in last that year's data which we are having with us, on the basis of that we can plan that 5%, 10%, 20%, that is a market growth of any product or service in the market. On the basis of that, we can plan the stocks for 3 months, for 4 months, or for entire year. So these kind of that thing that identify the reliable input, from where we buy the stock, buy the raw material, by the source of the raw material which is required. So that kind of thing we have. If we want to produce the 5 times or 6 times that stock in our organization, then we have to check that whether we are getting that much sufficient input from the sources, those who are the supplier of our raw material for the finished goods. So that all kind of things we have to assess properly, and then we can allocate that these are the resources, and we can expect that this is the raw material. We can borrow this raw material on these prices. We are expecting that on this price we have that possibility, and on the basis of that we prepare that much of goods, and we sold that much of good on this price. So all these things, they can be simultaneously correlated. So this is very important, that identify the reliable input and output prices. That is very important. Then the fifth one, the calculate the expected variable and fixed cost and all returns. That I have discussed in the case study, that which we have discussed in the last class. That what is the maintenance cost? What are the cost components under which we know that the fixed cost, that is to be done by the business at once, and then we are calculating only the interest and the depreciation on those assets, to whom we are keeping in the fixed asset. And where some things like that, the variable for day-to-day operation. In case of the animal husbandry, we know for keeping animals, so we require daily feeding. We require daily the other management practices. So for that we require for labor, for veterinary aids, for so and so on, for miscellaneous that things, those who are to be done, the AI for AI cost or like that. So we require that the day-to-day, that the money for performing these kind of information. So let us have a calculation that what is the fixed asset, how much we have to pay in the form of the fixed cost, and how much we have to have required the variable cost component to address the variable cost component. These price we have to calculate, and then we can assess the daily basis that how much animals we are having, so we can multiply that requirement of money, and then we can have that this much of money we require on daily basis for a particular business. So that kind of, and on daily basis we can multiply it with the 365 days that we are planning for a year, and 5%, 10%, that enhancement we can give over the period of the assessment of the last year, that budget which we are having in front of us, if that kind of information is available us with the budgeting. So now the business budgets, it's a six type of business budgets. They are available for running any business. Let us have a one by one discussion. That sales budget. Yes, this is the budget which related with the sales professionals, and this is the department which is responsible to convert money into the product, into the money, or a service into the money. So this department, they are very much focused that how much that the product which we have, and accordingly we'll discuss with the marketing professional and sales professional together that what kind of that forecast they are giving to us, and on the basis of that forecast we will have that kind of that budgeting for them, what kind of promotional that input is required, what kind of that transportation input is required. So on the basis of that we can have the salary and other expenses or incentives. Those all are the part of that sales budgeting. Then the second one is very important, which is that production budget. Yes, this is the budget, actually budgetary allocation here. That how much that we required for the production of that production of that particular product or service. So that kind of that from where they'll buy the raw material, what kind of the packaging material is required, how much that the quality control that segment is required. So all these things, that how much that allocation is required for the electricity and for watering, and all the facilities, those who are being required for the production of that particular commodity or for service. Then the third type of category is that financial budget. This budget is this budget is the key of any budget, because of the ultimately we require that what kind of that input we are having, and for addressing all the budgetary allocation of all the stakeholders in any business. Let us have a financial arrangement. How much we are expecting, and how much we can have to plan those to those stakeholders. Those they have submitted their budget for a year. Either it's a sales budget or a production budget or promotional budget or like that. Then the overhead budget. Yes, this is also the thing. Sometimes we require overdrafting. So this kind of budgeting is also being done for any institution. In case of the government, this was done very much. This was allocated by the state or central government itself. That if at all any exigency is there, then we'll have a plan to allocate the over budgeting, overdrafting, and that they are taking the sanction from the RBI also. So these kind of the budgeting is being called as a overhead budgeting. Then the personal budgeting, definitely, of course, everybody, individual, those either they are in the job or in the business or any kind of that the production that they are doing, they plan their own budgeting. So to whom we are calling the personal budget, that what kind of that income they are having, in what way their kids, their family, their livelihood, all things they allocate for a year or per month. Then we can say it's a partial. Then we can, for 3 months it's a partial. But finally for a year it can be called as a personal budget, like that. Then the master budget. That the master budget is nothing. It is just the sum of all the budgets, those who are being required, or they are being collected. Either it's a production budget, sales budget, or financial budget, personal budget, individuals budget. If this kind of that information all together we prepared, and we start that these are the things, those who are very much important. And that all the sum of that master budget is giving the entire that picture of any business, any government activity, to whom we can say the central budget of the state, the central government, the state budget of the state government, to whom we are calling the master budgets. And the company's budget, we can say that if the company is giving a final budget in for all the sectors, or for all the stakeholders, to whom we are calling the master budget. So these are the few that good information those we have discussed about the budget. And in next class, we'll discuss the balance sheet also. And I hope that we have a better understanding. But let us have a little bit discussion on the definition of balance sheet and all. So balance sheet is nothing. It is a statement of financial position of a firm or a business on a particular day. Showing its assets and liability status. It means what is the assets they are having, that business is having, the person is having, and what is the liability or equity they are having with liability and equity, whatever they are having with us on our particular day. So that kind of that is statement to whom we are calling the balance sheet or income statement. If liabilities are less than assets, then we can call it the net worth or equity. And if liabilities are then assets, then we called it net deficit. So these are two things. And assets, those who are owned by the farmer, and current, immediate, long term. That's the three category we are having. And the liabilities, things owed to others by the farmer, current, intermediate, and long term. So both are divided among three categories, and we'll discuss the all the things in our next coming that lecture that we'll have.
So, good evening, student. Today, I have decided to discuss a very vital topic regarding the same I have discussed in the previous class. That the topic is on balance sheet, and this is the very important tool uh, of financial transaction to assess the health, financial health of any business, financial health of any business. So, balance sheet, it is a statement of financial position of a firm at a particular time, showing its assets and liabilities and equity. It means these things, the statement on a particular day or particular time, it expresses the assets, liability, and equity status of any firm or any individual or any organization to whom we are calling the balance sheet. And this balance sheet is also we are giving the name of that ITR, that ITR is being filed on the basis of the balance sheet. So that is very important thing, important statement of any firm. Through this, we can have that idea that the firm, what kind of that the financial situation of that organization or that company is that. So on the basis of that balance sheet, we can have this idea, and the financial institution, those who are issuing the credit to any organization or any firm or even the state or central government, if they are producing their balance sheet of any public sector company or public sector organizations, that on the basis of that the financial that situation of the organization, that can easily be understood that what kind of that strength this organization is having. Through balance sheet, we can have idea that what kind of that financial that strength of that particular firm or organization is at present. And we can if we go through the 4 5 years balance sheet, then we can have that idea that in what way they are working as far as the finance is concerned. So if in what way they are utilizing their financial resources, that can understand, that can easily be understood, and it will become a self-explanatory when we'll go through these kind of the document whom we are calling the balance sheet. So if liabilities are less in from balance sheet, what we see, if liabilities are less than assets, it's called net worth. It means the if in the balance sheet, if organization, if we go through that, if the assets are more as compared to liabilities, it means the earnings and the capital, all these things, they are having much more that position as compared to the overdrafting or the pendency of the organization, or the what kind of that
that things they have to pay, what kind of money they have to pay, that all the things is also being called as a liability. So if assets are more, then the balance sheet being called as a net worth or equity. And if liabilities are more as compared to assets, if that kind of situation is there in balance sheet, then we have to critically analyze this thing, and we are calling this situation as a net deficit, as a net deficit. So that let us have further elaboration of assets. Those are owned by the owner, by the firm, by the institution. About the balance sheet we are talking, it means whatever the those are owned, they have the ownership of all the things to whom we are calling the assets. And liabilities, things owed to others by farmers. It means, for example, if the bank loan, it means the product of bank is finance, that the amount of the money which they are giving to the farmer, it means the bank is owning of that thing, but farmer is taking that commodity to whom we are calling the credit, or the financial assistance which we are taking from the bank. That is a product of the that the ownership of that particular product is of bank, in case of that the money if they are providing to the farm. So that it means the ownership of that thing which farmer, or which any firm or any organization is incorporating in our business, that is liability, so and accordingly the situationally we are calling these assets and liability current, intermediate, long term assets, current, intermediate, long term liability. So these are the three categories under which we got the information from the balance sheet, that how much current assets are there, how much the medium or intermediate assets, how much the long-term assets they are having with them, and how much the current liability, intermediate liability, or the long-term liability. So all these things, they are self-explanatory in the balance sheet. Now I'll see that I'll give you one example of that balance sheet. You see that here the clear cut, that everything is clearly explained, that current assets and current liabilities both are clearly mentioned over here. This is the balance sheet of farm on a particular day. The rupees I have also mentioned for better understanding. That the cash in bank, here the cash in bank 20,000 rupees. Okay, but the account payable to loan deposit, we are talking about the current assets and current liabilities. Okay, it's 15,000 rupees. Then petty cash 5,000 rupees. So these are the 25,000 rupees. They are the current assets immediately they are having in their hand, and to whom we are calling the net cash. Then the wages, all then the office rent and the maintenance cost, and then the annual installment, all these to all together they are 77,000 rupees in the section of the liabilities. And here in the section of the assets, net cash, we know 25,000 rupees is that firm is having with them. Then the value of crop which farmer they are having in their for the sale, 80,000 rupees. Livestock product, that milk and all, they are getting 20,000 rupees. And agro poultry product ready for sales, that is, then the value of that bond or SIP is sometimes that the securities, if the farmer is following this thing, 5,000 rupees. So total that assets at present, whom we are calling the current assets, they are 1,40,000 rupees, and the liabilities, current liabilities is 77,000 rupees. It means that this is the net worth position. It means this balance sheet is indicating about the current assets and current liability net worth, that position. Then we will go to the intermediate assets and intermediate liabilities. Intermediate assets, first one that we go dairy cattle, bullocks, poultry birds, machineries, all these they are the intermediate, because they are having, but farmer is not selling this thing, but they are the assets for the farmers. So that, for example, the dairy cattle 20,000, bullocks 8,000, poultry 10,000, machinery and equipment 3,000, like that. So subtotal is, if you'll see that the subtotal is about 3,48,000. That is the total of current assets and intermediate assets. Now we'll go into the section of the liabilities. Here the intermediate liabilities. LPM loan, if he has taken loan for the animals, that is 50,000 rupees. Machinery equipment loan 8,000 rupees. Unsecured loan, if he has taken 4,000 rupees, it means here the 37,000 rupees is the intermediate liabilities. It means that that thing he was supposed to pay, but not immediately, after 2 3 months, after a year, like that. Then finally we have a long term assets and long term liabilities. So that long term, it means land, book value, buildings, all these, they are the long term assets, to whom we are calling the long term assets. For example, 20 lakh rupees and 15 lakh rupees, that buildings cost is there. So now it's a 35,000, 35 lakh rupees, that kind of that asset the farmer is owning, with to whom we are discussing over here. And in the liability section, you'll see that the insurance and fixed assets loan payable. If he has taken loan on the farm building, or on the land, then they are the long term liability. So if it is 2,10,000 rupees, suppose he was supposed to pay the interest and the loan on these kind of things. So they are the long term liabilities. So now, if you see in this example of this balance sheet, that 39 lakh 48,000 rupees the assets, and here the 33 lakh 34,000 rupees liability. So this is the balance sheet which indicating the good health of a business, good health of a farm business, and it's a worthy balance sheet. It's a worthy balance sheet. And if the situation is reversed, if liabilities are more and the assets are less, then it's a net deficit. Then this balance sheet is not that much of worthy. It's a deficit, net deficit balance sheet, that we have to understood. Now the connecting thing, which is whom we are calling the profit and loss or income statement, that every individual is required to submit that income and loss statement, to whom we are also calling the income tax return. Through income tax return, we are submitting the ITR through the profit and loss statement. A profit and loss statement is financial statement that summarize the revenue, cost and expenses incurred during a specific period of time, usually a physical quarter or a year. Generally, we prepare quarterly, monthly, sometimes in some business house, but finally we'll issue for the 1 year. Revenue is the money you receive in the payment for your products or service. Operating or variable expenses are expenses that rise or fall based on your sales and volume. So these are sometimes the variable that expenses we are, and revenue we are, the revenue which we are earning through the sales of the product or service. Then the gross profit margin or operating margin is the amount left when you have subtract operating expenses from the revenue. When we'll subtract the operating or variable expenses from the revenue, then we'll see that this thing will be called as a at the profit or loss, on the basis of the situation. So overhead or fixed expenses are costs that do not vary much month to month and don't rise or fall with the number of sales you make. Example might include salaries of office staff, rent or insurance. These are the overhead, that fixed expenses. Monthly we can calculate them, and then we can add them in the profit and loss statement. Operating income is the income deducting operating and overhead expenses will do. Then we have the operating income. Other income or expenses non-operating generally don't relate the operating side of the business, rather to how the management finances the business. Other income might include interest or dividend from company investment. For example, other expenses might include interest paid on loan. Pre-tax income is the income before federal and state government take their share. Income taxes. How income taxes is shown on public in profit and loss statement, but corporation, partnerships, LLCs, and sole proprietorship rarely show income tax expense on profit and loss statement. They are not showing this thing in the profit and loss statement. Net income after taxes is the final that amount or most profit and loss statement, if we represent the net total profit earned by the business during the year, that financial year, above and beyond all related cost and expenditure. So these all are the few terms, those who are interconnected with the with the balance sheet. That's why I have discussed this thing in detail, and I hope now you have a better understanding what is the balance sheet and what are the things that I have discussed, and other you can ask through the questions through the SMS and through the message box. You ask some question if you have any query, and